So we'll see what any developments are between now and, who knows, the end of the day. And in subsequent days to come as well. Joining us now on All Things Markets is Schwab's head of investment strategy, Lizanne Sonders. It's good to have you with us. I guess you didn't realize you'd be leading talking about the Fed, but here we are. And this squabble, if you will, between Powell and the president. That's how I'm characterizing this whole thing. I mean, what would it mean, do you think, for the market if the president tried to fire the Fed chair? Forget about whether Mr. Powell decided to leave or not. Just the mere fact that he would be fired.
You know, Scott, I'm often asked what are some of the big risks that maybe fewer people are talking about that you think would cause trouble for the market via confidence crisis or otherwise. And my answer has always been any serious threat to the independence of the Fed. Now we're potentially facing that head on. I think it would be unquestionably a negative in a backdrop where we already have a lot of uncertainty. You know, it was interesting to listen to Steve. I've known Kevin for more than 20 years, and I agree with everything that Steve said. I think he is an independent thinker. He believes in the independence of the Fed. And it's interesting that not only has there been reporting that Treasury Secretary Bessent has pushed back on the president about potentially trying to fire, and we don't even know whether he could even do that. But there's also some reporting that maybe Kevin Warsh also imparted that message to the president. So maybe we can, find some hope in some of the pushback that's happening, because I think this would undecidedly be a negative for the market.
I mean, it's yet another sort of storm cloud that's kind of hanging over the market, but one that's already been blanketed with fog, including how you and others in your profession are trying to view these markets. You took all your sector recommendations down to neutral recently.
I did.
Speaking to this very point, visibility is terrible.
It's terrible. And the last time we did that was in the early part of the pandemic, which was also the time, like we're seeing now again, where you saw at that point, it was a record high percentage of companies that just withdrew guidance altogether to the analysts covering their stocks. So we're already hearing an increasing number of companies either doing that or doing, like I think it was United Airlines the other day that came out with two scenarios, sort of a base case based on what they were thinking prior to the onset of this trade war as we know it now, and then a worst case scenario of a recession. So I think that's going to be the story of second quarter reporting season, is the absence of guidance. That doesn't mean analysts are not going to pepper their companies with questions about how are you navigating this in the near term? Are you holding off on long-term CapEx plans? How do you anticipate you might be able to protect your profit margins? So I think there will be a lot of color that comes out of this, but the precision around guidance won't be there. And what we're seeing is when sort of left to their own devices, and this happened in 2020, analysts, their bias was to lower estimates. So I think the path of least resistance, the direction of travel, is still down for estimates that have already been coming down for now 17 consecutive weeks for calendar year 2025.
Oh, they sure have. Definitely earnings growth expectations have been steadily coming down. So what are you advising and investing on, right? You can't rely really on corporate guidance, but nobody can. Do you just make an assumption that eventually there are going to be big trade deals, that we're going to do some kind of deal eventually with China, and then we'll move on to tax cuts and deregulation, and thus you put a toe into the market? You guys have a tough job, in this environment.
I'm not making any assumptions in this environment. I think that makes absolutely no sense. We see on a day-to-day basis that the headlines can really cause things to swing on a dime. And I wouldn't attempt to get inside the minds of either the administration or some of the trading partners that are coming to the table, in part because there have been, different messages in terms of what the ultimate goal is of tariff policy as it exists right now, and therefore begs a lot of questions about, okay, what could the deals represent? What could those concessions? I don't know that answer to that any better than anybody else, which is why the best thing you can do is look inward and say, all right, am I comfortable with ongoing risk in this portion of the portfolio? And if the answer is no, then there's probably things you can do from an asset allocation perspective. Neutralizing our sector recommendations, taking a factor approach, investing in factors based on characteristics that is very high quality, low volatility in nature to try to navigate sort of within the confines of a very volatile equity market. But it is a really, really tricky time because we're so at the mercy of policy decisions that are just coming rapid fire on a day-to-day basis.
The other issue in trying to hide, there's been no place to hide. I mean,
Right.
Equity market's been going down. The bond market was shaken up. So people were seeing their bond holdings, go down. Gold, I guess, has been working. Currencies haven't been a reliable safe haven play either. I mean, that's muddied the strategy, too, for the kind of investors who look to Schwab not only for trading activity, but for advice.
Well, we have been, not just in the recent weeks, but we have been really trying to reinforce the benefits of diversification globally, not having your eggs all in the U.S. equity market basket. And that had been a big theme around the U.S. exceptionalism. So we do always really push on the idea of diversification across and within asset classes. Scott, you and I have talked many times on this program in the last year or so about being mindful of concentration risk and how individual investors shouldn't have felt this pressure to be so overweighted in a group like the Magnificent Seven because they're not benchmarked on a quarterly basis to the S&P 500. That's an institutional problem. So it is times like this, though, that I think sometimes makes investors aware if their emotional risk tolerance and their financial risk tolerance have a yawning gap between them. And it's unfortunate that sometimes it's a volatile period that brings that to light. And that's just the best way to help investors navigate through this is actually saying, what is your plan here? What is your financial risk tolerance? What is your long-term strategy? And then, work back into what that makes sense from a asset class perspective.